Hi, hello, welcome friends. In this video, we are going to discuss about financial instruments unit 2. We have completed in last class unit 1 relating to definitions. Financial asset means what, financial liability means what, and equity means what. So these three definitions was completed in last video, and now we are going to unit 2. In year unit 2, classification and measurement of financial assets and financial liabilities. Here what is there, this classifications in for recognition and subsequent measurements. So here the initial recognition, how can we measure the financial instruments, and a subsequent measurement, how can we measure the financial instruments, here we will discuss it. So whatever the assets will be there, we need to measure at fair value at option of initial recognition, and classification of financial assets financial liability derives their initial and subsequent measurement. So we need to measure in fair value at the time of initial recognition. For this, after subsequent recognition, you can choose FETPL or FETOCI, FET amortized cost based on your nature. Here financial assets, key elements to determine the classification. For the purpose of classification, we have some elements will be there. These elements will help which option you can choose. You can go for the fair value option, or you can go for the fair value of amortized cost, or you can go for the fair value of amortized cost, or OCI cost. Here first element will be business model. Business model, we have an entity business model refers how entity manage its financial assets in order to generate cash flows. So here we have one financial assets. So how we are engaging, how we are managing that financial assets, so how we are generating the cash flows from that financial assets is the main important feature here. So for the purpose of business model test, we need to consider some factors. What are the factors we need to consider here? This business model will manage the financial assets, so in the matter of fact, and not merely the accessions. So we do not have the accessions. So accessions means it may be rights, obligations, and completeness, accuracy. These accessions we does not have. So here we have fact. Really we have the managing the this financial asset. And here we have activities. Some activities will be what is our objective will be seen. So for this asset, what is our objective, and we need to judge we have managing these financial assets or not. So management of financial asset will be required for first option. Next, after that, here if assessment, for if you are not assessing this judgment means, here we need some professional judgments. If you are not determining in a single factor, then you need to know more options. So what is the relevant evidence we have that is available to such relevant evidence includes, these are exhaustive definitions, means here they will give only some elements, and if you want you can add. So this is exhaustive definition. So here how the performance of business model and financial assets held within the business model evaluate and reported to the entity's key management persons. So here management KMP, how they are be performance measuring, or how it is model is evaluated. We need to see how the KMP is reported. This is key managerial person will report the performance, how he is reporting is the main first point. We see that a point. After that, the risk, what is the risk will be there. So how the KMP is reported first point, and after that what is the risk affecting that performance business model, and here particularly the way in which the risk is managed, and after that, and here how the manager of business is compensated. So if you have any problems, how he has compensated. For example, whether the compensation is based on the fair value of asset managed or contractual cash flows. So we need to see fair value of asset or contractual cash flows collected. So we see in after this BM model, we will see that contractual cash flows, component financial instruments. We will look after the overview. Here, for the purpose of factors determining the business model, first we need to see that is whether the financial asset will be there. For that, what is the financial assets objective, and we need to judge the and assessment. So for judgment, we need to see whether the KMT how he is reporting, and what is the risk is there, and how the risk is managing, and how they are compensating, whether they are compensating through financial value of financial fair value of asset, or they are compensating through contractual cash flow collected. And levels of aggregation of assets for determining the business model test. So two levels will be there. One is here the entity business model will at this level reflect how the financial assets group is managed. So financial asset is managed together to achieve a particular business objective and not based on the management intent. So we need to see business objective, not management intentions. So they have one financial assets, how they are using is the main important, not their intention to use. And they will purchase for intention, but they are using for other purpose. So we need to see the how they are using is the main important. And here the according the conditions is not in instrument by instruments. So here condition will not be instrument to instruments. We will see the in a total black value. So total black value how they are using, not their intention. And after that, how the single entity have more than one business model. If some cases one institution only, that financial institutions have more financial assets. So more financial assets means they have more business models also possible in these financial instruments entities. And we need to see how they are managing these financial instruments, and how classification is not be determined at the reporting level. So for example, if one entity is holding portfolio, so portfolio means different stocks will be there in that basket, it is known as the portfolio. Here in order to collect contractual cash flows, so contractual cash flows means this interest amounts, dividend amounts, whatever you have the contractual cash flows, we will see later. And what is the another portfolio of investment that it is managed in order to trade realized fair value changes, means if we sell that what is the value, capital appreciation. So contractual cash flows means whatever the interest, whatever you are discussing, what are decision, if you purchase one bond you will get the interest, that is contractual cash flow. If you sell that amount, that is fair value of a debenture, you will get the asset value, that is market value you will get. So for level of aggregation, we need to see that BM test is financial assets business, what is the business level, business objective, we will see particularly business objective, intention of individual instruments, what is the main here, and high level aggregation we can do. After that, determining basis of realization of contractual cash flow. So here entity's business model determines whether the cash flow will result from contractual cash flows or selling financial assets. So in business model, we need to see, for if you have purchased one debenture, so from that debenture how much interest we are getting, or if we sell that asset how much amount we will get. So we need to determine that the result of that contractual cash flow is high, or selling of financial asset will be there. Consequently, this assessment is not performed on basis of scenario that the entity does not reasonably expect to occur, and so-called worst cases or stress cases. So some debentures does not have value in the market. So then that it is not possible to test that assets. Next, we need to see that debenture, what is the debenture realization value, what is the interest they are paying. For example, if your entity is there, entity is selling one particular, so it is selling one particular portfolio. So for the financial assets, only stress cases, if you have only stress cases, this scenario would not be affected. So if you, so for example, it COVID is running in the market, so in the COVID time so many stocks prices was went into down, and some pharmaceutical companies stocks were went like anything. So in that cases it is not possible to test whether this debenture is correct or not, whether this contractual flows is correct or not, whether the financial assets value is correct or not. And entity assessment of the business model for those assets, if entity reasonably expects the such scenario will not occur. And what is the difference in actual realization from the business model? We need to see how much we are purchased, how much we are expected, how we are recognized in the books, and what actually we realized. Here cash flows sometimes it may be different from the expectation at the date that the entity assesses the business model. For example, if entity sell more or fewer financial assets then it expected, it's classified. So in books, we are books of accounts, we are classifying the M to M, that is mark to market. We are classifying our assets, so means whatever the market value is there, we are accounting as per that. If you have 100 rupees value when purchasing, after 1 month it was went up, so mark to market means we need to record that unrealized gain. After that, if the price is went down, we need to record that unrealized loss also. So we are recording that type only. When asset is selling, this all whatever the unrealized gain, unrealized at the end of the day, what is the value and how much we are selling is the main important. And here, for example, if you are going to sell some portfolios, then entity's financial statement now does not change, nor does not change the classification of the remaining financial assets held in that business model. For example, those assets that are the entity recognized prior period and still hold. So if you are hold for the long position and if now you are selling some assets, you do not change the remaining assets existing in that portfolio. Here for the long position we need to see that business model assessment. After that, what is financial assets held for trading? If the financial assets is held for trading, we need to account as a, if you see in the accounting standards, India is accounting standard 13 investments. If you are holding for the trading purpose, it will be marked as mark to market, and we need to see cost or market value, whichever is lower. If you are regarding for the long position, we will need to go for the cost only. Now if you are that financial assets is held for trading, means you are in that business, financial instruments business. Now you are required or incurred any principal for the purpose of sale or repurchase of near terms or any initial recognition as part of portfolio of identified financial assets that managed together, and for which the evidence recently actual pattern of short term profit taking or derivatives, that is expect those that are financial guarantee contracts are designated effectively hedge instruments. So here the financial assets, if you are trading, how can we decide whether this is for trading or whether this is for a long position? So we need to see the what is the principle they are, how what is the purpose they are purchasing, means they are purchasing for the resale, they are selling or repurchasing that near terms. So they are intention to sell, they are purchasing, and we need to see what is the initial recognition is also part of this cases, or whether they are actually pattern, what is the pattern, they are going for the short term profits or they are waiting for long position. And what the derivatives, if derivative means the contract which the value is derived from the underlying assets, so we need to see that cases. If the assets derivatives are for the guarantee contracts or designated effective hedge instruments, it will go for the long positions. And we will need to see these 3 points. First will be intention, they are purchasing for the sale purpose or a repurchase purpose, or here actual pattern, what is the actual pattern for that assets, and derivatives, what is their hedge effective hedge instruments. And generally here Trading reflects active and frequently buying and selling, and financial instruments held for trading are normally used with objective of generating. So here we need to see the objective of that profit from short term fluctuations in price, and dealers margin will be there. For if you are entering for derivatives, we need to pay some initial margin. For example, contract value is 1 lakh, so we need to pay the 20% has the margin, that is initial margin will be held for this. For example, they are provided one illustration. What is there in this illustration? For example, if we take this here, so one entity is there, here entity is there, and they are collecting some contractual cash flows. For example, if we take debenture interest example purpose, and this fund needs the entity are predictable and maturity of financial asset matched to the entity estimated funding needs. So they are went for 3 years bonds, so maturity will be 3 years, and when fund is needed, this person is needed after 3 years only, and they also repay after 3 years only. Here the case will be there, and this entity's performance credit risk management activities with the objective of minimizing the credit loss. So how they are working this entity, and we will see that credit rating. First, when the person is entering into contact, he will see the credit rating. Who will provide that credit rating? This Moody or Credicel and some other person, they will provide the AAA rating or AAA plus ratings. That the cases, and here entity performs some credit rating activities typically occurred when financial assets credit risk is increased. If we have AAA plus, it will be good, means high rating, it will be low risk, that the case will be there for this credit ratings. So here we will see the credit criteria specified in the entity documents. So investment policies, what the credit rating they are mentioned, and in addition that infrequently sales have occurred as a result of unanticipated funding needs. So if some cases unanticipated fundings, we do not have the fundings, we have done for the sales, so infrequent sales. So if you are not continuously selling the products, means if you are in one business, you are opening in a seasonal work. So for example, if you take this crackers, they will open only mainly that Diwali times, and another they will see only festive season they will open. In that cases it is infrequent, or they have unanticipated fundings will be required only that particular time. And here reports to KMP, so who is the person, key manager person, they will focus on credit quality of that financial assets and contractual returns. Here the entity also monitor fair value of financial asset among other information. Now we need to estimate that business model, so whether this business model is come into contractual cash flows or no. So here one entity is taken, so here one entity will be there, and they are considering some information. So we have some information we are collected now, how KMP is reported, that conditions will be there, we need to take that point, and what is the their values. So here the persons have financial assets, so we need to see that fair value. Fair value means how much we will realize it at the point of time. If the entity is trying to sell, then what is the cash flows we need to see, and what is the entity objective. So entity objective also required to hold the financial instruments. So they are holding for contractual cash flow, or they need to, they are for the sale purpose, so they are like getting the interest, or they are buying, selling, buying, what is their intention we will see. So what is the objective, entity's objective, what is the financial assets fair value. After that, here sales would not contradict. So if you here they are selling, if we that are selling, we need to see the objective. So the objective is not contradictory. If they are response to increase any assets of credit risk, so we need to see credit risk also, whether the low risk is there or high risk is there, high rating is there or low rating is there, triple A rating or B grade ratings. We need to see these are credit risks. So we need to see financial assets fair value and intention objective. What is the objective? Whether the objective will be holding or they get contractual cash flow. After that we need to see the what is the response, what is the credit risk of that assets. So we need to see for these three items. Here in the our business model, the company is to collect cash flows, contractual cash flows, not realization from the sale of financial assets. So they are paying the amount. So they only starting itself they are told that collecting their contractual cash flows. So funding the entity is predicting the financial assets matched to the entity, maturity will be there and contractual cash flows will be there, and credit quality minimizing the risk. So when we want to go for the long term, long years, then we need to decrease our risk, then only persons will purchase. So they are trying to go for the long position, means they are trying to pay the only interest only, they don't want to sell it. So it is relating to contractual cash flow, collecting contractual cash flows means they will get the interest amount regularly, they are not for the sale of that financial assets. So they are not in that business. Well, that is the case. And second cases, if you see here, same one entity is there, sorry here. So one entity is there and he also purchased one financial assets portfolio like that loans. So financial assets there, and this portfolio may or may not include in financial assets. So they have conflict, they may into financial assets or not. If the payment of the loan is not made on timely basis, when this is not included in financial assets, if the payment of the loan is not made on timely basis, or the entity attempt to realize the contractual cash flow through various means. For example, the contacting the debtor by mail or telephone or other methods. So they are calling for the money, or they are following through telecom, or they are writing some letters. So they will using the different method to get the cash. So what is the entity objective here is to collect the contractual cash flows, but the entity does not manage any of the loans in their portfolio with the object of realizing cash flow from selling them. So they do not have any objective for realizing the cash flows by selling them. So here also what they are doing, they are entering and they are not for sale. So they are going to expect this contractual cash flow. So we need to apply this entity is receiving all contractual cash flows in assets or money, we need to see. And after that, in this some cases the entity enters into interest rate swaps. So rate swaps means it will become the derivative. So we have in the swaps, what is there? Swaps means exchanging the cash flow series, it will not have the swaps. In swaps different swaps will be there, one may be interest rate swap, one may be currency swap, and one may be total return swaps. So total return swaps, this type of swaps will be there. Swaps also one type of derivatives, and here they are going for interest rate swaps, particularly financial assets in the particular from floating rate to fixed assets. So in interest rate swap we will take the fixed to float or floating to fixed. If currency swap, it will be going for rupees to USD to dollars to rupees. In total return swap we will give our total assets, we will take other person's total assets returns will take. In that cases these types of swaps will be there. Swap means simply exchanging the series of cash flows. Here we need to see first what is the business model objective, whether they are holding the financial assets in order to collect contractual cash flow. So the financial assets, whether the objective is to get the contractual cash flow. So here the same analysis would be applied even if the entity does not expect to receive all the contractual cash flows. So Now their intention is contractual cash flows, get the contractual cash flows, but they are not getting contractual cash flows, then also the analysis will not change, because some financial assets credit impaired at initial recognition, so credit rating also we will see. So moreover, the fact of the entity enters into derivative to modify the counter cash flows of the portfolio does not itself change the entity's business model. So here they have contractual cash flows only, but they are changing these contractual cash flows into different methods. So they are getting fixed, so they are fixed, they are going for flat. So this is, they are changing the contractual cash flows, that's enough. They are not going into different, so they are not selling that assets. If they are selling the assets, realizing the profits, selling the assets, realizing the profit, it will become the business, it will not the contractual cash flows. So they are in contractual cash flows only, but they are changing that cash flow. So because of changing the cash flow, it will not change the case objective. Next, after that, question number 3. In question number 3, we will see that entity B is there, is selling goods to customers on credit basis. Here up to 60 days he is giving credit period 60 days for to make the payment in full. So entity B collect cash in accordance with the contractual cash flow. So whatever the amount they are decided, they will get that amount. And here the trade receivables and has no intention to dispose receivables. So what is the business model? Here entity objective is collect contractual cash flow, even though they are giving time only for the purpose of to encourage their customers to purchase our goods from ourselves only, they are giving the credit. So by giving credit, they are not leaving any amount. So they are not leaving any amount means here this is contractual cash flow, but we need to recognize it in a amortized cost. So here trade receivables will be there, and trade receivables business model will be classifying as financial assets at amortized cost. So how much time we are giving, based on that time we need to amortize it. So here only 90 days means it is not come in the recognitions, because 90 days means it will come in the within 3 months only. So if that 3 months also in between the financial year means that is entered in 1st March, so 1st March means only 30 days recognition is required, and remaining 60 days will come under next year. And after that, here 4th question, entity A is there. So one entity has anticipating capital expenditure in few years, means they are going for investment, they need to incur some capital expenditure. So capex expenditure will be there. So capex expenditure, the entity is investing excess cash in short term and long term also. So they are investing in one assets, they are incurring for short term and a long term financial assets, so that it can fund the expenditure when the need arises. So they are funding the amount when they required, so arises when they required. Many of financial assets have contractual leaves that exceed the entity's anticipated investment period. So they are assuming for 1 year, but it will going for 2 years. So investment period is going like anything. And for example, if we this is in real estate business, in real estate business almost their timing also going like anything. They will tell within 1 year we will complete the project, but they are not completed within 1 year. And the entity will hold some financial assets to collect contractual cash flow. So they are hold some financial assets to get the contractual cash flows, because to run the business we need some cash flows will be required. And when entity opportunity arises, it will sell that financial asset and reinvest the cash in financial assets with high returns. So if you have got any opportunity, they will sell, and after that that sale proceeds also reinvest in high returns cases. So in equity we will get the high return. This private equity funds, hedge funds, they will get the high returns. But if we go with the private equity funds, they will be closed-ended mode. But if you go for the hedge funds, they will provide the open-ended funds, so we will get the high returns in the short term. So any asset, anytime if you want, it is better you go for the hedge funds. So that is the case. So here the company is what they are doing, they are selling, but the sale proceeds also reinvesting where the company is getting the higher returns. The manager is responsible for the portfolio or remunerated based on the overall return generated. So now we need to evaluate the business model. So for the business model, firstly we need to see what is the objective. Here objective of the asset we need to see. So there are both, we have contractual cash flows will be there plus selling financial assets will be there. So both objective will be there. Now we need to see another conditions. When the entity's decision is ongoing basis, other whether they go for the contractual cash flows or selling the assets, so they are going for contractual cash flows, so they are trying to get the always contractual cash flows, it will become contractual cash flows. They are going for selling assets, it will become the selling assets. But here we have both scenarios. So what they are doing, they are selling but they are also reinvesting in the high interest cases, high returns places. Now they will see whether the contractual cash flow or selling financial assets will maximize the returns. So we need to see whether the contractual cash flows is getting more amount or by selling they are getting more amount. So until need arises for the invested cash. In here the consider the entity anticipates cash flows in 5 years. So we need to see 5 years anticipation. For example, 5 years projections we need to see. In that 5 years projection, what is the fund capital they have, what is the fund expenses, and fund how much they invested, how much excess cash they are got in short term finance asset. So we need to see the 5 years projection. So in 5 years projection, what is the amount they are invested and what is the amount they got, what is the income assets from the short term assets, what is the excess cash they have received, we need to see that cases. And when the investment maturities, the entity what the reinvestment the cash in new short term financial assets, so they are reinvesting in other assets where they are getting high return. So we need to see that also. And here the entity maintain the strategy until funds are needed. So in at which time the entity uses the proceeds for maturing the financial assets to fund the capital expenditure. So we need to see this strategy, whether when they are fund is rising and whether at the time of uses, so what they are doing for that proceeds by maturing the some asset they are maturing from maturing of that assets proceeds will be coming. So what they are doing with that proceeds, and value occur before the maturity. Now here we need to see credit risk also. The credit risk, it will have AAA plus or B grade, we need to see that credit risk also. So we need to see first objective, that whether the objective is for contractual cash flows or sale of assets. But in our case both will be there. When we have both, we need to see already what they have done in past or present. So 5 years projections we will see how much capital expenditure they are going to incur, how much contractual cash flow they will get, how much sale proceeds they will get. And for the fund rising, when they are selling, so when the capital is required then they are selling, or their intention is buy and sell, or they are selling for the purpose also they are reinvesting to get the higher returns. Now in their objective, their intention is always tying is contractual cash flows. So they are not selling for the purpose of to get the profits. So when they are trying to get the profit, it will become the business like. So buying shares, selling shares, buying shares, selling shares. So they are intention is not to get profit from that buying selling, so they are sale proceeds using for reinvestment only to get the higher return, that is contractual cash flows only. So this business model is contractual cash flows only. Next, fifth illustration. In fifth illustration, here objective need to see. So they in one entity how loans was given to their customers, and subsequently these assets will selling to securitization. So ESPB will be there to these loans are selling to special purpose vehicle. For this special purpose vehicle, and the securitization will what they will do, this will issue securities. So they will issue the securities. Here they will see now what will be happen. Some loans is there, it will given to SPV, they are issuing the securities. That securities will be PTC securities or PTS security or interest to interest security or principal to principal security. So they may issue any cases. And here the originating entity means this loan person how control on this SPV. So and consolidated the SPV, what they will do, they will collect contractual cash flows from here. When they issue securities now, they will get the contractual cash flows, they will get the cash and asset them to its investors. It consolidates balance sheet loan continue to recognize because they are not de-recognize the security vehicle. So now we need to see that it is related to contractual cash flows or they are selling that assets. So here the loan the bank, this person loans person is giving this SPV and in a recourse basis, he is not giving in a non-recourse basis. We need to see here. Now here the ongoing agreement loans to customers have objective to realizing. So what is the objective here? They are realizing the contractual cash flow by issuing the shares. They are not selling exactly, they are issuing some securities, they are realizing their cashes contractual cash flows on road portfolio only through selling through securitization vehicle, that is SPV. By using this SPV, they are issuing some bonds and they are getting that contractual cash flows. So however, they are consolidating the original loans with the objective of holding them to collect the contractual cash flows. So here the intention, here the objective is to get contractual cash flows. And now because they are consolidating financial statement provided for business model with the objective of collecting contractual flows by holding to maturity. They are till the time of maturity they are holding and they are getting the loan amount, full loan amount in the form of by issuing the securities. And here the separate financial statement, if we see in consolidated financial statement, they will recognize it as a contractual cash flows holding for maturity, holding to maturity. In separate financial statement, the entity originating loans to customers. So business model is to contractual cash flows through sale only. So loan, that loan person, that is bank, they will recognize in contract separate financial statement as it is a contractual cash flows. In consolidation financial statement, contractual cash flows by holding to maturity they will recognize. We have two types of financial statement. One is consolidated financial statement, I think consolidated financial statement, separate financial statements. So standalone financial statement we will discuss in different standards will be there for this consolidated financial statement and standalone financial statements. After that, question number 61. In question number 61, what is there here? One financial asset will be there, financial institutions like bank. If you take HB bank, no, we will take the SBI bank for better understanding. So they have some financial assets. So in this bank they have some financial assets, they are to meet the liquidity need to stress cases. So they are in stress cases for this financial assets. In these assets exception such scenario, here this entity always need to see the credit rating. So who will provide this credit rating? The CRESI or Moody or S&P or separate person, they will provide the credit rating. For AAA or B grade, they will provide the credit rating, and the entity need to monitor that credit quality of that financial assets. So, and here the objective, what is the objective? Objective will be they need to objective will be collect the contractual cash flows, collect contractual cash flows will be the main objective of our SBI. And now the entity is evaluating performance of assets based on the interest revenue and credit loss realized. So for this contractual cash flow, they are seeing how much they are interest they are getting and how they are getting creditors related. So some assets is not paying, how we are selling in a market, how much we are realizing, so realized value. So they are seeing for contractual cash flows interest plus cash flows realized. And after that, how the however the entity also monitors the fair value of financial assets from liquidity perspective also, to ensure that cash amount that would be realized, so how much they are realized. And if the entity needed to sell assets in a stress case scenario, they would be sufficient to meet the, so here they are, see this case, so they are selling some assets also. We need to see this selling position, why they are selling. In worst case scenario they are selling, or they are normal regular way they are selling, so we need to see that case also. So here intention of selling also we need to see. At the time of liquidity perspective, cash amount that would be realizing if the entity needed. So when they are needed the cash, they are selling, or they are regular course they are selling. So if you are going for regular sale, so it will become the sale, the intention become the sale. So if they are not in a regular case they are selling, this is it will become the contractual cash flows only. So they hold for contractual cash flow, but because of the some stress cases, because of some condition they are selling, they do not have the intention to sell. So we need to see the intention of what they are intention when they are selling. So periodically the entity makes sale that is the insignificant in value, or the sale value is realizing the amount will be significant value or insignificant value, we need to observe. Because of that credit loss, when the asset is does not have the value, even though they are selling they will get the insignificant value only. So even though they are selling, they get insignificant value, then it will become the contraction cash flows only. So here we need to see that what is the objective. Firstly we need to see objective of entity. Here there are all some financial assets. So financial assets, when we will sell contractual cash flows, contractual cash flows collect to contractual cash flows, when we will tell does not change because they are selling. Because why they are selling is the main important. They are selling in a stress case, and selling amount also they are getting insignificant value, does not more value they are getting. So one year need to see analysis will be required, it will not change this contractual class. So if one person come, so they are selling, why you are writing in the contractual class, why you need to write in the sale na. So we will tell that, so they are selling, I can understand, but why they are selling is the main important. Because of some unconditional situation they are selling, and they are selling which have the low credit they are selling, and they are getting amount in a low value, that is insignificant value they are getting. So this will the reason I am writing in the contractual cash flow. So here the cash flow analysis does not change, because they are, it's during previous stress case scenario the entity is sell that were significant in value in order to meet the liquidity. So why they are selling? To meet the liquidity, and they are selling in a recurring, but the amount what they are getting is insignificant. So regular course of business only they are selling, but the what the value he is getting is insignificant value. So here the value is not inconsistent with holding financial assets to collect the contractual cash flows. Now entity is required by its regulatory to routinely sell financial assets to demonstrate that assets are liquid. So the here even though the entity is selling the assets in regular basis, we does not change the cash flows, and the value of assets sold is significant. The entity business model is not wholly for financial asset to collect. If they are selling in regular courses, they are getting significant value from sale of assets, then it will not become the contractual cash flows. So the entities nature does not become the contractual cash flow. It is become the sale, actual sales, business sales, so purchase selling is there. So that is the case, we will recognize in that way. But here in our case they are selling, but for they are getting insignificant value. The entity business model is not to hold the assets. When it does not have hold the assets business model significantly, what is the entity objective, we will need to see here. The third party impose requirement to sell the financial assets, or that the entity is at the entity's discretion or not relevant to the analysis. In contrast, if the entity is old financial assets to meet its everyday liquidity needs, and meeting that objective involves frequently selling. So to meet our liquidity they are selling financial assets, and the objective of the entity business model is not to hold the financial assets to collect contractual cash flows. Next, here contractual cash flows characteristic stress. So we need to conduct some test in India AS 109. So here we will discuss India AS 109, that is financial instruments. Here the entity to classify financial assets on the basis of contractual cash flow characteristics. So what are the characteristics for financial assets is held for contractual cash flow? So we need to see first business model objective. So business model, we will need to see objective of business model, and this objective model, what is the objective of this business model? So we will see the objective of business model. So by both collecting the contractual cash flows and selling of financial assets. So we need to objective, for the objective we need to see the what is the contractual cash flows, what is the selling amount they are getting from financial asset selling. And to do so, an entity is required to determine whether the assets contractual cash flows and solely payment of principal and interest on the principal amount outstanding for the currency in which financial assets is denominated. So we will see entities required to determine whether the contractual cash flows have solely payment principal plus interest. We need to see that one also. Here the interest on principal amount outstanding and currency in which financial asset is denominated. So what is the principal amount and what amount they are paying as a interest, and how they are mentioning denominating these financial assets, whether they mentioning in USD or GBP, how they are currency, which currency they are using. So we need to see the key characteristics of cash flows for the test solely payment of principal assets and interest. So what is the principal here? So principal means fair value of financial assets at initial recognition. So however the principal amount may change over the life of financial assets. So this we will see first of all that principal fair value of financial assets at initial recognition. So we have recognitions, initial recognition and subsequent recognition. Based on our objective, the recognition will be changing. Means if you are holding for more days, and we need to recognize in a amortized cost. If you are doing for the get the profits, it will go for the profits, FET PL. If you are converting that OCI, that is it will become the FET OCI. We need to see for the purpose of recognition conditions also. So why the principal amount is changing over the life, how they are changing. If for example they are repaying principal amount, they are paying only interest amounts, or they are paying solely principal plus interest amount outstanding in a consistent basis. So we need to see the what the basic lending arrangement. And originated or purchased financial assets can be a basic lending arrangement irrespective of whether the loan, whether it's a loan in its legal form. So the legal form of the loan will be considered here. Basic lending arrangement, that is consideration time value of money we will consider. So we need to consider the future values into present value, then we will know the case. And for the time value, and we also need to see the credit risk of the most significant of interest. So whether the entity is how money to pay or not, whether the condition of the entity is good condition or not. We need to see the credit risk also. However, in such an arrangement, interest can also include. So for interest consideration for other basic lending risk, liquidity risk, and we need to see the lending risk and plus cost and plus profit margin and consistently basic lending arrangement. So for the component of interest element, we need to see the liquidity position, we need to see the cost, what is the cost is associated for that asset, we need to see the profit margin, how they are getting consistently, which how much margin they are getting, and some extreme economic circumstances. So if the interest is negative, what the case scenario. So if the interest is, they are, for example, they are holding one financial assets, though they are deposited some amount for particular period of time and the fee is exceeding consideration. So if, for example, if you are given some gold in the bank and the gold collects some bank deposits, so security deposits, so you are holding more years, they are collecting more amounts. One day whatever the amount you are paid, it was become more than the gold value. Some cases it become that cases. So if we see what is the time value of money we are paid and what is the credit risk will be there, what is the basic lending risk and cost will be there, we need to see all items for the interest components. However, here contractual cash flows also we need to expose risk or volatility of the contractual cash flows. So unrelated to basic lending arrangement, such exposure to change in equity price and commodity prices, so do not give rise to contractual cash flows that solely payment. So because they are paying principal, because of they are paying principal, we will not consider them, which is not a contractual cash flow. So we will see the all contractual terms what they are exposing, whether the risk is there, whether the volatility of the cash flows what is there. And leverage, we need to see the leverage. Leverage means some entities will do in a derivative concept, so that is they do not have the cash, they do not have the shares, but they will borrow that shares and sell in the market, and later when the buy price is decreased, then they will buy from the market and they will repay. This is leveragers, means they do not have the actual money, they will do the business in leverages. So then at that point of time when they are borrowing shares, at the time of they will repay, they need to pay some interest also. So at that point of time, what is the characteristics of that financial asset, we need to see what is the increasing variability contractual cash flow, and they do not have the economic characteristics of interest. So standalone option forwards and swaps contracts are examples. So financial asset that includes such leverages. So financial assets have more leverages. See, we will see in financial assets, these hedge fund managers will go for the short selling. So short selling, we have this type of contracts only, so only on payment of principal and interest, and hence cannot be subsequently measured at amortized cost or fair value to OCI income. Next, after that, some following examples for contractual terms that result contractual cash flow. So if we see in cases, it will become the contractual cash flows that are solo payment of principal and interest on principal amount outstanding. See, it has variable interest. So if it have variable interest, so variable interest rate on financial instruments, where this rate consists of consideration. So for variable interest, we need to consider time value of money and credit risk and other basic risk we need to see, means profit margin. So for the purpose of rate consideration consists of variable interest rate, we need to see the time value and we need to see the how much risk they are ready to take, how much lending risk will be there, and as well as what is the profit margin. And this is because the variable interest rate is only to provide lender with a return through interest based on the present market factors. So no other forms returns on principal amount of financial instruments. So characteristics of returns will be character. So for the purpose of calculating, for example, if you are taking loan, example, so if you are taking loan means you do not pay only interest. So at the time of entering the loan, you need to pay registration fee, document fee, and application fee. These are all expenditure we need to consider. So for the purpose of interest comprehension, we need to consider all expenditure also. That is the case we are telling. And after that, contractual terms. What are the contractual terms? For the permit the issuer, that is debtor, to prepay the debt instruments, or permit the holder to put debt instruments back to the issuer before the maturity, and prepayment amount substantially represent up unpaid amount of principal and interest on the principal amount outstanding. So which may include reasonable additional compensation for the early termination of the contract. So some cases they will go for the early termination. When going for early termination, they need to pay the compensation. So for reasonable additional compensation will be implies a party choosing exercise option to terminate the contract compensation with the other party. Now some cases we have exceptions for that prepayment option also. Some cases implementation could result in other party being forced to accept negative compensations. So for example, here we have one lender will be there. So lender receive amount less than unpaid amount principal plus interest. Interest if the borrower choose prepay. Here what we go, if there are unpaid amount is there, lender is ready to some person is not paying, regularly not paying. Now the lender will give the option that person you are not paying properly. So if you pay prepay, if you pay prepay, then he will give take less amount, ready to take less amount. Here because of that lender receive the amount less what is required. For example, 5 lakhs is the loan amount. 5 lakhs is the loan amount. So 5 years will be the time period. Here they will give the person option to repay within 3 years. So for you, if you pay in 3 years, when I need some money, you need to pay repay. So they will give the discount. He is ready to get the less amount here in this case. So earlierly these financial instruments will be measured as FVTPL. However, now after the amendments, financial assets could be measured at amortized cost or at FEG OCI if they meet the other relevant requirement of India S 109. So this type of loans we need to recognize FVTPL in past, but now amendment says that you need to recognize in FVT OCI or FVT fair value at amortized cost based on the relevant requirement. And now the exception, to eligible the exception, fair value of prepayment feature would have insignificant of initial recognition of amount. So the value difference amount have insignificant value, that it will get the exceptions. So when it will be get the exception, it will be recognized at FVTPL. Now it will become the FVTPL. It is exception cases. So when the it have insignificant, it will get the exception, and it have exception, it will go to the FVTPL. Now contractual cash flows that permit the issuer or the holder to extend the contractual term of debt instruments. So what is the extension option will be there, and how the terms of extension option is there. So if they have extension, so in first case we have see the prepayment. In some cases they will extend the loan. So then when they are extending, we need to see the extension terms and extension options and options for the results of contractual cash flow during this extension period. Solely principal payment is there plus interest is there of outstanding, and reasonably is there any additional compensation they will get. So when they are exchanging, they will try to get the more compensation for this contract. So for example, we will see some illustrations. So in illustration, here one person have bond. it has maturity dates. For example, if we will take of 5 years, they are not given time, we will take 5 years. So here the payment and interest is paying linked to inflation index. So we have floating interest. So in the case of interest rates, we have fixed rate and floating rates. Fixed rate means they will fix the rate. Floating rate means they will give based on inflation. They will give libor plus 2%, they will give inflation plus 2%, or they will go for mibor plus 2%. So in our case, we have based on inflation they are providing. Based on normally this inflation index rate we take by the senior persons who required this shelter, clothing, income, food. They will bother about the inflation. So this category of persons who are senior citizens persons, they will choose this inflation bonds. Always try to get this inflation bonds. Because of the inflation, they do not affect their source, means their health, their food, their clothing, their shelter. So they will not affect because of inflation. They will go for this inflation bonds. Here inflation amount interest payments, a principal amount is linked to inflation index of the currency. Now instruments is issued. In instrument inflation link is not leveraged and principal is protected. Here what they are going, principal is protected to inflation payment of interest and principal on the principal amount is. Now here we have, when he is issuing, we have to get principal plus interest. This principal is inflation index of currency. Now contractual cash flows are solo payment of principal and interest is there for the principal outstanding. The principal, this for pre interest and principal and interest, principal amount is unleveraged inflation index resets the time value of money at to current level. So we will see the what is the inflation now, maybe what will be the inflation for next year, whether the inflation is going to up or whether going to down. We need to see that cases also. Here the inflation rate will reset the time value of money at current level. In other words, interest rate on instruments reflect the real interest. So we have two types, that is one nominal interest cases or real interest cases. Now interest amounts are consideration to the time value of money on the principal amount outstanding. Now however here interest is where interest payments are indexed to another variable. So interest is variable such as debtors performance, based on the debtor performance. So example, debtors net incomes or equity index and contractual cash flows are not payment of principal and interest on the principal amount outstanding. So unlike the index to the debtors performance result in the adjustment, the only compensations the holder for changes in the credit risk of the instruments. So such as contractual cash flows for solo payment of principal and interest. So we need to see that is contractual cash flows is there or only solo payment of principal and interest is there. Now this, because the contractual cash flows reflect return that is inconsistent with basic lending arrangement. So when they are linked to other, here they will be inconsistent will be there for basic lending. After that, illustration number 81. In illustration number 81 we have F bond. So F bond, they are converted fixed number of equity. So it is bond going to equity, fixed number of equity instruments issued. Now we need to analyze the cash flows. So for the cash flows, the owner would analyze the convertible bond entirely. What are the cash flows? So contractual cash flows are not payment of principal plus interest on the principal amount outstanding, because they reflect the return that is inconsistent with the basic lending arrangement. So the return is linked to the value of entity. So here this will have inconsistency of basic lending arrangement. So we do not know whether the value will increase or whether the value will, if we are entered bond only, at the time of maturity we will get the principal, but here the linked that value relating to equity. In previous case also linked the inflation, so it will become the inconsistent with the basic lending arrangement. So we need to see the lending arrangement, whether the payment is payable at the maturity time, principal amount we know or we do not know. So when we know, it will become normal cases. We do not know, it will become the inconsistent in basic lending arrangements. So when there is basic lending arrangement inconsistent, then equity of issuer will be there. What is the linked value is there, we will recognize it. Next question number 9th one. In question number 9th one instrument is there, instrument H. It has perpetual. Perpetual means what? Perpetual means they will pay the regular interest, but they do not have the maturity, that is known as perpetual. Here but the issuer may call the instrument at any point of and pay the holder the par amount plus accrued interest. Whatever the amount is there, they will pay par amount plus accrued interest at any point of time. So perpetual means they will pay the any point of time, they will not specify the time. That is the case in perpetual cases. Now instrument H pays a market interest, but payment of interest cannot be made unless the issuer is able to remain solvent immediately afterwards. So deferred interest does not accrue additional interest. Now what is the nature of cash flows here? So nature of cash flows will be, first we need to see contractual cash flows. So here the contractual cash flows is not payment, principal plus interest. Principal plus interest, principal is on the principal outstanding, so they are not paying the principal plus interest because they have option to pay at any time. Now this is because the issuer may require to defer interest payment and additional interest does not accrue those deferred interest amount. So as a result, interest amount are not consideration for the time value of money, principal amount outstanding. So we need to not consideration time value of money, principal outstanding. So if the interest is accrued on the deferred amount, the contractual cash flow would be payment of principal plus interest on the principal amount outstanding. So it will principal plus interest amount outstanding only, because we don't know the when to pay. They will pay at any time, so we do not know amount, so the interest became the deferred amount. The contractual cash flow could be payment of principal plus interest on the principal amount outstanding. Next, for example, here we have instrument D. Then in recourse basis, what is this recourse basis? Recourse basis means we will send the loans to other person. Other person we need to issue some bonds, SPV. In we have seen in one case now that SPV will issue the securities, SPTC or PTS securities. That PTC securities, they will get the money from the persons. If this SPV not able to get the amount from that issuer, then it will reback the assets what they are getting. So they will reback. So the bank or financial institution which have given the loans or assets, they will get when the SPV is not able to pay the get the amount from that persons. This is recourse basis. Now loan collateralized with recourse basis, so thus it does itself affect the analysis of whether contractual cash flows are solely payment for principal and interest on the principal amount outstanding. So the collateral is only has a security recovered dues, so we cannot recognize it solely for principal and payment. After that, here instrument G is there, so one G is there, and that payment is inverse floating rate. Here inverse floating rate, here the interest rate has inverse relationship to market interest rates. So now we need to analyze the cash flow. Here it has paying interest and pay, but they are does not have the proper cash flows, so it is not for solely principal plus interest, so they are not holding solely for principal and interest. So here the interest of instruments have inverse relationship of the market rate of interest, so unlikely we do not have to have basic lending arrangements. So in between these two persons, they do not have the lending arrangements. Means lending arrangement means they will specify one rate and you need to pay this amount, then it will become the solely for principal and interest. In our case does not have that solely interest and principal payment, which normally compromises of interest payable on any fund lent and as consideration of time value of money. So they will pay based on the time value of money, and best they will see credit risk plus they will see the profit margin of such arrangements. So here they will get maybe higher amount or lower amount based on the market rates or interest or how not necessary consideration time value of money principal amount outstanding. So the contractual cash flow that are solely payment and principal the does not represent contractual cash flows solely for principal payment or cash amount, so interest and principal amounting. Next, asset classification overall concept. What is there in overall concept? So we have three classification. So we can go for the method at fair amortized cost, or we can go with the fair value through OCI, or we can measure at fair value through PNL, profit and loss. So as per India is 109, we need some exceptional cases also for this financial asset derecognition for fair value to PNL. For that we have seen the BM model and contractual cash flows. So these are exceptions for FVT PL, and here financial assets are measured at amortized cost, FVT OCI, fair value to PNL. When we'll go for the fair value of amortized cost, so basically to these conditions met, we need to go for the amortized cost. So amortized cost means when fair value of assets held within the BM with whose objective is to hold financial assets in order to collect contractual assets. So financial assets was hold to get the contractual cash flows, and contractual terms give rise on specified date to cash flows that solely payment plus principal. So solely payment for principal plus interest and amounting, that is the case. Then we need to recognize in the amortized cost if it was fair value through profit and loss. So FVTPL means if any asset which is not amortized at amortized cost and not measured at FVTOCI. So we do not going for FVTPL, FVTOCI, or we are not conditions mentioned as per FVT amortized cost, then we need to recognize FVTPL. Means FVTPL means not this is just we need to recognize in the PNL. FVTOCI means we need to recognize in the OCI portion. FVT amortized cost means we need to recognize the amortized cost. That is the difference. So in FVTPL, when the given scenario if not measured at FVT amortized cost or FVTOCI, then we need to measure at FVTPL. And if an initial recognition any assets may irrecoverable be designated as FVTPL, its specific criteria was met. So FVTPL criteria meant we need to recognize any FVTPL. And FVTOCI, when we go for the FVTOCI, financial assets shall be measured at FVTOCI when the conditions met. So financial asset is held for BM test is passed and achieved by collecting contractual cash flows, selling financial assets. So here the selling will be there, but here we do not have the selling, with only collecting the contractual cash flows. And after that, here contractual terms will give specified dates. So some date will be specified, dates will be specified, solely payment for principal plus interest, principal amount outstanding, and equity amounts is not held for trading, and contingent consideration in business combination for which entity makes irrevocable elections and initial recognition to carry out FVT OCI. So here we have three cases measured with FVT PL, FVT amortized cost, FVT OCI. And after that, here some exceptions will be there for that above recognitions. So financial assets means amortized cost, FVT OCI and FVT PL. So FVT amortized cost means we need to see BM test. In BM test we have contractual collect to contractual cash flows, and plus that contractual cash flows may be PI and contractual cash flow test. And for FVT OCI we need to collect and sell. We need to collect and sell, and we collecting and maybe SP plus PI or contractual cash flows. So in FVTPL, when the assets is held for trading and there are residually category cases also, FVTPL recognition will be there. Now amortized cost they are providing, and here examples of financial assets classified at amortized cost. So examples will be trade receivables or government bonds, investment in government bonds which are not held for trading, or investment in term deposits, that is standard interest rate will be there. Loan receivables with basic features, investment in equity instruments can never be classified as amortized cost. So we need to see the trade receivables, government bonds and term deposits, and loan receivables, basic feature loans. Thus these are all classified as amortized cost. Now we will see one example. So in this example we have one debt instrument. For example, we will take the debenture has there 1 lakh will be debenture. So here they will pay the interest of 6,000 per 10 years they will pay. So when purchase, the entity intends to hold the assets to collect the contractual cash flow. So their intention is collect contractual cash flows. So collecting contractual flow means this is hold to collect business model test. So debt instrument meet the condition hold to business model test. Now same the entity is there and they have at the 6th year have passed an entity suffering liquidity crisis and need to sell the assets. So they are selling and they will get the amount by selling the assets. Here also the business is held to collect. So held to collect business model, held to collect business model, because they are initially they are not expected initial classification and does not affect the classification. They are not retrospective reclassification is required because they are selling in a stress cases. So because of some liquidity position they are selling, so retrospective reflection is not required. And after that here one zero interest and fixed payment. So one H limited is there and it has given loan to subsidiary, and loan is current classified as current liability in year. It has liability, so current liability in yes financial terms. So they have terms will be interest was get, they are not paying any interest. So they got the amount from the holding and they are not paying any interest, and they do not have the fixed repayment terms also, and repayable on demand of parent. So whenever the parent want money they will ask. So then yes is need to pay means on demand. This was on demand. Thus the loan meet the SPPI or contractual cash flow characteristics. Now here yes the terms of repayment, principal amount of the loan. So what is there, principal is need to payable because there is no interest rate, means it is interest free loan. So here we need to pay only principal portion. The principal portion is meet the definition of SPPI because the loan on demand is satisfy the criterion of SPPI. Next SPPI test or contractual cash flows. So here same P is there, parent entity, and subsidiary S is there, and loan is 100 millions loans, and loan following the no interest, interest is not there, and repayable will be 10 years. Now INR millionaire subsidiary, loan following terms, no interest, repayable in 10 years. Now the H is not have the demand, so they are given 10 years time. Now also they have amount loan in 10 years satisfy the criterion of SPPI. The term of repayment will be their principal amounts. Now one company entity A is there and B is there, same 5 millions and 10 years time. Here the interest rate will be there, interest is 10%, that is variable interest, repayable in 10 years. Now here the amount will be contractual cash flows will be there, they are entered at the time of entry, at the time of contract they are entered to pay the interest on a regular basis. So when they are required to pay amount, it will become the contractual cash flow. So they have the contract and they have the cash flows. So it will become the contractual cash flows. So contractual cash flows, that is both fixed rate and fixed rate sorry here fixed rate and floating rate instruments or payment of principal plus interest as long as the interest reflect in consideration for the time value of money and risk. So here the contractual cash flow, so it will become contractual cash flow. So it has both fixed interest fixed rate instruments and floating rate instruments of payment of that principal plus interest as long as interest reflect consideration for time value of money. So this contractual cash flow we need to consider based on the time value of money plus what is the credit risk will be there. So it was meet the combination of fixed and variable interest rate meet the contractual cash flow test. So when we have solely for principal payment, it will become SPPI. Now when we have payable, that contractual cash flow, it will become contractual cash flow test. When we have contractual cash flow, we need to see that combination, what is the fixed or variable interest combination meet the rate, and what is the interest rate considering the time value of money, and credit risk also we need to consider when it has contractual cash flows. Now here one case is there. So H is the person made the sales, and to for example B, and he is given some 60 days credit, and the customer is entitled to 5% if he pays within 60 days. If he has not paid within 60 days, if more than or equal to 60 days, you need to pay 12% interest also. And company does not have the policy of selling its debtors and hold them to collect contractual cash flow. So in this case, the H limited is firstly they have right. What is the right? They have contract is there, and they have right to collect the cash flow. So contractual cash flows is there from the its customers, and there are such trade receivables. Trade receivables means it is financial assets. Now further H limited business model we need to see. So they are providing the time na. So when we have time, we need to amortize the cost. So we need to follow the amortizer cost, because the objective is to hold the trade receivable to collect contractual cash flows till the end of maturity, and such trade receivables recorded in the books represent contractual cash flows. So that are solo payment of principal plus interest is beyond credit period. So the receivables are classified as amortized cost. Next after that one example. So company A is there. So here we will say company A will be there, and B is there. Carry lease to carry on its business. The lease contracts will be 5 years time will be there, and year lease agreement is there, and paid some security deposit. On this security deposit, they will whatever the amount security deposit, so 10 lakhs will be the security deposit, and which is refundable after the lease agreement. So the lease agreement will be 5 years contract period. So after 5 years they need to repay this amount. So how the such deposit will be pay in the books of A limited. So here company got some deposit amount, so they are not paying any interest, only they are collected that amount, and they will need to pay them after 5 years. So 5 years time is there, so it will be recorded as amortized cost. So here contractual right to receive is there from the lessor B, and therefore the such security receivable as financial asset. So when the receivable is there, it will become financial asset. Financial asset is there, and we need to test that business model test, whether it is for contractual cash flow or solo payment for principal and interest. So here the security deposit is received to collect the contractual cash flow till the end of maturity period. So and the such trade receivables recorded in the books represent contractual cash flows solely payment of principal and interest. So hence such security deposit receivables are classified at amortized cost. We need to recognize that amortized cost. Next FET OCI, we need to see FET OCI whether to old to collect and sell we need to see, and SPV test, contractual cash flow test, we need to consider. For example, for financial assets classification, investment in government bonds. So investment in government bonds likely to shorter than maturity period. So for they also provide that commercial papers, 90 days bonds, 180 days bonds. So we will see that cases. So what are the investment and investment corporate bonds, where the investment period is likely to be shorter than the maturity period. We will see that FET for example, if we see one person is there, that is entity A is there, and he has some funds, 50 million funds is there, and entity is not yet found suitable investment opportunity, so it by the medium dated 5 years maturity, so high quality bonds. So he has cash, he has investing in bonds, that is government bonds, he has investing in government bonds. So if you are invested in bonds, you will get the interest amount. So in interest amount income, if the suitable investment opportunity arise before the maturity date, the entity will sell the bond and use the proceeds for acquisition of business operations. So when this better opportunity is there, you will redeem these bonds, and or no, they redeem not, you will sell these bonds, and that amount will used for their business operations. So it is likely to suitable business opportunity will be found before maturity. So they are whether the investment opportunity will be mid the L to collect or hold to collect and sell business model test. Now we will see that firstly they are old hold to correct, because they are collecting the interest and they have sell business model. So whenever the value was increasing before maturity also, they are ready to sell, that is business model test will be sell to business model also. So both the condition will be satisfied. So in the year government would not meet the hold to collect business model test, because it is considered likely the bond will be sold well before the contractual maturity. So when hold to collect means at the time of maturity they will collect the full amount, it will become the hold to collect. When here it is the not case, because they are ready to sell before the maturity time also. So they are holding only because they have surplus funds, they need some time, they are investing, so they are investing before the maturity period also, so before the short term period also. So for 90 days bonds also will be there. And after that equity instruments, when it is classified as FET. Here FET equity portion key, so assets, financial assets, so all equity will be always fair value, and all changes of fair value assets we need to recognize in the profit and loss assets. So we will see the mark to mark, if there any changes we need to recognize it. And however equity instruments are not hold for trading, entity can make irrevocable election at initial recognition to classify the instrument at its FET. So all subsequent changes we need to recognize in OCI. So if the market value is changing for this equity, we need to recognize as per that. Next, using the under FEOCI category, fair value of changes is recognized in OCI, while demand are recognized in PNL. So in PNL we need to recognize that dividends. And if you are disposal some investment, the cumulative change in fair value is required to remain in OCI and not to reclassify. So for equity portion amount, that unrealized gains or unrealized losses, we should not reclassify in PNL. So however the entity have ability to transfer amounts between reserves within equity between FET OCI retained earnings. So financial assets in case of FETPL. So FETPL means when we are not recognizing in FET OCI or fair value amortized cost, then it is the residuary position FETPL. Financial assets will be classified at and measured at FETPL if financial assets held for trading financial assets, and a debt instrument does not qualify to measure at amortized cost or FET OCI, and equity instruments which not entity is not classified as FET OCI. Here examples of financial assets classified as FETPL, some derivatives, so not been designated in hedging relationship. So when we have interest rate swaps, so it will be FETPL. Commodity futures and options contracts, so it will be FETPL. Foreign exchange futures options, it will be FETPL. Instruments in shares where entity has not elected to account as for FET OCI. That is the case. Now we need to measurement cases. So for measurement of financial assets. So what is the initial measurement and what is the subsequent measurement? So in initial measurement, fair value will be normally evidenced by the transaction price, that is fair value of consideration given or received. Where part of consideration is other than financial instrument, then entity shall measure fair value of financial instruments. Next, subsequent measurement. Normally here, what is the transaction price, what is the transaction price given or received, and part of consideration other than financial instrument, then entity shall measure fair value of financial instruments. And subsequent measurement, so fair value at amortized cost we can see, and fair value at profit and loss, fair value OCI. So amortized cost means what is the initial recognition, we need to recognize principal repayment plus cumulative interest by using the effective interest rate. So at the time of measurement, we need to see the what is the principal repayment plus what is the effective interest rate. And for FETPL, FETOCI, for fair value is determined periodically, and fair value for equity instruments cost may represent fair value in some situations. In some situations, based on the interest and dividend recorded in PNL and gain or losses recorded in PNL. In FETOCI, it will be dividend recorded will be in PNL, gains or losses recorded in OCI. Dividends will be recorded in PNL and gains or losses will be recognized in OCI cases. Here EIR means effective interest rates. So for debt investments or derivative instruments or equity instruments, we need to see what is the contractual cash flows. Whether contractual cash flows is solo payment for principal plus interest. And here first this test was pass or fail. So if the test is fail or if the test is pass, so if the test is pass, then we will see the business model test at entity level. So if the business model test is at the entity level, whether the hold for collecting the contractual cash flows, or when if we are they are holding for collecting for contractual cash flows, they we need to fair value will be elected based on the amortized cost or FETOCI. So if we are not going for this amortized cost or FETOCI, then we will need go for the FETPL or the solo payment for principal and interest. At the time of initially it's a fail, we will go for the FETPL. If a fail solo payment of principal plus interest is fail, but we need to see whether that is held for trading. So it is for held for trading, then we need to see that whether it has FETOCI option elected or not. If they are elected, then it will be FETOCI, otherwise it will become FETOPL only. And we need to see some accounting transaction cost for the purpose of effective interest rates. So transaction costs. So what is the transaction costs? How can we recognize it? So for example, originating fee so originating fee received by the entity relating to creation or acquisition of financial assets. So such fee may include, so in originating fee we include compensation for activities, borrowing financial conditions, or evaluating or recording guarantee, collateral, other security arrangement, negotiating terms, and preparing processing documents and closing transactions. What are their integral parts? Here whatever the fee charged for servicing the loan, it is known as originating fee. And commitment fee, commitment fee means it is integral part of effective interest. So integral part of effective instruments, so this fee as integral part. So originating fee is integral part of effective interest. So for servicing the loan, whatever the amount they are charging. Commitment fee, it is also commitment fee, entity originating a loan where it is probable that the entity will enter into a specific lending arrangement. So this fee is recorded as compensation for ongoing involvement. So commitment means ongoing involvement. They are the fees recorded compensation for ongoing involvement with the acquisition of financial instruments. So if the commitment expires within the entity making the loan, the fee is recognized as revenue on expiry. The commitment fee means to originate a loan when it is unlikely that a specific lending arrangement will be entered into. So if they are entered any commitment, then it will be recognized as here we will see. So originating fee, it will become, if it is servicing the loan, they are collected some fee, then it is not a integral part of effective interest rates. So if the originating fee for the purpose of relating to creation or acquisition, then it will become the integrated part of effective interest. So integrated means it is main part. For example, if we see, we have, if we incur some expenditure, the expenditure on the ongoing time, it may become capital expenditure or revenue expenditure. Capital expenditure means we need to add to capital assets. Revenue expenditure means we need to recognize it in profit and loss. So the character will decide whether it is capital expenditure or revenue expenditure based on the integration. So we need to integrate with capital asset, or we need to recognize in P&L. So same like as in effective interest rate, whether the fee, originating fee, it will be included in effective interest rate, that is integrated, or it will not integrated when it will not recognize it. So if it is service in the loan, it is not integrated to effective interest rate. If it is originating fee for the compensation or evaluating borrower's financial conditions, regarding guaranteeing guarantees or collateral or other security arrangements, or negotiating terms, investments, preparing the processing documents and closing transactions, and fees of integral part involvement with resulting financial instruments, then it will be integral part of effective interest rate. And after the commitment fee, so commitment fee, if they are originating a loan when unlikely that specific lending arrangement will be entered into, so they do not have the specific lending arrangement, then it will not part of the effective interest rate. So it is not integral part. When entity to originating a loan where it is probable that entity will enter into specific lending arrangement, so they are entered some specific entity arrangement. So when you are in the question, if it's given the commitment fee, so we need to see the terms and conditions. So the terms and conditions will probably they are entered how the specific lending arrangement, then it will integral part of effective interest rate. Next, originating fee. So first one will be originating fee and origination fee, and next commitment fee. After that, another term, originating fee, here paid on issuing the financial assets method at amortized cost. So the here first transaction cost we need to recognize through amortized cost. In loan syndication fee, so they are collecting some amount like document charges, service charges, it will not integral part of the effective interest rate. So here they are provided one illustration. So here one bank is there, ABC bank is there, give a loan to customers. The target customer will be target company. They are paying fixed interest rate. Fixed interest rate will be 10% and time will be 5 years, and 12% per 3 years term. So if we go for the 3 years term, if you go for the 3 years, then it will become 12%. So then additionally bank will charge processing fee of 1% principal amount borrowed. So normally if we go for the 5 years, it will be 10% fixed interest. If you go for the 3 years, it will become the 12% interest rate, and they will charge processing fee of 1%. So now this processing fee become integral part of effective interest rate or not, we will see. Here the terms, what are the terms will be there, 10 lakhs for term of 5 years. So they have taken 10 lakhs for 5 years and 8 lakhs for term of 3 years. Now compute the fair value of option, initial recognition of the loan in the books of target limited, and how will loan processing fee accumulated. So they have this processing fee na, so how they can recognize this fair value amount, that fee amount. So here the loan from ABC bank carry 10% interest is there and 12% interest is there. So for this 10% it is 5 years and this 12% it is 3 years. Okay. respectively. Additionally, there is processing fee will be 1%. So main topic will be on this 1%. Now on principal amount and the date of transaction. So it is assumed that ABC bank charges all customers in a similar manner, and hence this is representative in the market rate of interest. So they will charging for all customers. So the whoever entering into bank, they know that they are ready to pay the 1% amount has a service fee. Amortized cost is computed by discounting all future cash flows at market rate of interest. So further, any transaction fee, so it is the transaction fee of 1%. If it is integral part of the transaction, then we need to adjust in effective interest rate and recognized over the term of instrument. So here the ends loan processing fee shall be reduced from the principal amount to arrive the value of day one in upon initial recognition. So when that processing fee becomes integral part of that loan, then we need to compute by accordingly. And here we have for fair value of 5 years term loan and fair value of 3 years loan. So here we need to calculate the transaction fee and amortize over a period of time. So for that purpose, we need on the principal amount we need to deduct that transaction amount. So 10 lakhs will be amount, and on that 1% will be the transaction price. 10 lakhs minus 10,000, 9 lakhs 90 full amount fair value of that loan, and 8 lakhs minus 8,000, it will become 7 lakh 92,000. It will be the fair value of the loan. Now effective interest rate shall be higher than the interest rate, that is 10% and 12% on 5 years and 3 years loan respectively. So those are the processing fee get recognized as interest over the respective terms of the interest. This is the case. So they are giving some transaction fee, some originating fee, some service fee. So we need to consider whether it is integral part or not integral part. When it became integral part, we need to deduct from the main amount, then only that principal amount became the fair value of the amount. Next, what is the fair value here? Here fair value means we will discuss in the Ind AS 113 will be there, that is fair value we will discuss in 113. There are some conditions will be there for this fair value, and we will discuss in there. So measurement determining the all following. So current market conditions, so particular assets or liability that is subject to measurement, that is consistently its units of amount what is there, and non-financial assets, what is the valuation premises that is appropriate for the measurement. So consistently with the high and best use will be used. So they have primary market, secondary market, and most advantageous market, and some cases it have highest and best use cases, and some valuation technique also with there, that DCF method or equity method. Different methods will be there. Discount DCF method means discount cash flow method. So in discount cash flow method, we will see that cash flows will be discounted at some appropriate rate will be there. Appropriate rate will be considered for the calculation. Now for financial assets initial measurement we will see in the next video.